Welcome to Money Mode, the channel that makes money talk less confusing and way more useful. Let's get into it. Have you ever wondered how some traders make massive profits or massive losses in just a few days? The secret often lies in two powerful tools, options and futures. They look like stocks, they trade like stocks, but underneath, they play by completely different rules. Today, we're breaking down exactly how options and futures differ from regular stocks and just how risky they really are. Let's start with the basics. When you buy a stock, you're buying a small piece of ownership in a real company. If the company grows, your shares grow in value. If it struggles, you lose value too. But your risk is capped. You can never lose more than what you paid for the stock, and there's no deadline forcing you to sell. Options and futures work completely differently. They're called derivatives because their value doesn't come from owning anything directly. Instead, it comes from a contract tied to the future price of an asset, a stock, a commodity, even a currency. Let's talk about options first. An option gives you the right, but not the obligation, to buy or sell an asset at a fixed price before a certain date. There are two types: call options, which let you buy at that price, and put options, which let you sell at that price. Here's the twist. You don't pay the full price of the asset. You pay a much smaller fee called a premium. That's what makes options so attractive. With a small amount of money, you can control a much larger position. This is called leverage, and it can multiply your gains dramatically. For example, a small move in a stock's price might turn a modest premium into a profit worth several times your original investment. But leverage cuts both ways. If the market doesn't move the way you expected before the option expires, the entire premium you paid can vanish completely, leaving you with nothing. Unlike stocks, options have an expiration date. Time itself works against you, a phenomenon traders call time decay. Even if you're eventually right about the direction, being early can still mean losing everything before the price catches up. And if you go a step further and sell options instead of buying them, the risk multiplies. Sellers can face losses far larger than the premium they collected, sometimes even unlimited losses, depending on the position and how far the market moves. Now let's look at futures. A futures contract is an agreement to buy or sell an asset at a specific price on a specific future date, but unlike options, it's an obligation, not a choice. Both sides must follow through, no matter how the market moves by the time the contract settles. Futures are also traded on margin, meaning you only put down a small fraction of the contract's total value up front, sometimes as little as 5 or 10%. This creates enormous leverage. A small price movement in the underlying asset can create a huge swing in your account, positive or negative, far larger than the percentage move in the market itself. If the market moves against you, your broker can issue what's called a margin call, demanding more money to keep the position open. If you can't cover it in time, your position may be closed automatically, often locking in painful losses right when you can least afford them. So how do these compare to simply owning stocks? With stocks, your downside is limited to your initial investment, and time is on your side. With options, your downside as a buyer is also limited to the premium you paid, but time works against you every single day. With futures, and with selling options, losses can exceed your original investment entirely, making them some of the riskiest instruments available in the market. That doesn't mean options and futures are inherently bad tools. Professional traders and institutions use them every day to hedge risk, generate income, or speculate on short-term price movements with precision. But they require a much deeper understanding of timing, leverage, and market behavior than simply buying and holding a stock for the long term. If you're new to investing, it's worth mastering the basics of stocks first before stepping into the world of derivatives. The tools that offer the biggest potential rewards are almost always the ones that demand the most respect, the most discipline, and the most careful risk management. This video is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial advisor before trading options, futures, or any other financial instrument. If you found this breakdown helpful, hit subscribe for more clear and simple explanations of how the financial world really works, and let us know in the comments what topic you want us to break down next.